Good afternoon, everyone. Thank you for joining us today, and welcome to the first installment of the Loan Vision's Industry Insights webinar series. My name is Jordan Pavelka, Marketing and Communications Manager here at Loan Vision, and I am joined today by Jennifer Hanna and Tyler House, who will be leading the discussion on today's topic, How do you measure up KPI benchmarking from your peers in the mortgage industry? As an assurance partner at Richey, Jen provides consulting advice to her clients, specializing in mortgage banking, real estate, nonprofits, and 401k plans. Tyler manages the peer group in the business advisory services practice, which provides data analytics and business intelligence services to the firm's mortgage banking clients. Jen and Tyler, how are you guys doing today?
Great.
We're doing good.
Doing good.
Good. That's wonderful to hear. Good. Before we jump into today's presentation, I just have a few couple housekeeping items. We are indeed recording today's call, and we will be sharing it to all registered attendees. All attendees are also muted, but we do want this to be interactive. So if you have any questions, please send them to us, and we will have a question and answer session at the end of the demonstration. Without further ado, I'm going to pass the time over to the industry experts today. Jen and Tyler, go ahead. Take it away.
Thanks, Jordan. Let's see if I can get everything set up. Oh, there we go. I got the slides to work. Here's our pictures. Sorry we're not on video today. You know, we just didn't want to block the charts that we're gonna show today. But here's our picture so you guys can see us. Looks like actually I forgot to update our email. We'll correct the slides.
Send the slides out.
Anyways, here's us, and you know we're excited to be here today. You know, we love to present with the Loan Vision crew and all of our, you know, we have a lot of common clients, so it's great to get in front of you guys. And it's a fun topic today to talk about benchmarking. And we are going to spend, you know, some good time looking at some numbers today from 2020 for most of that call. But whenever I do a call like this, I always like to kind of sidetrack the session a little bit and talk you know, about a story outside of the numbers, you know, where we see measurement and benchmarking kind of playing a role in history. So hopefully that's okay with you. You know, since we're not in person, you can't, you know, give me a disgusting look like, why are we wasting my time? You're kind of along for the ride. So we're going to do that. Oops, I'm a little early on the slides there, but we're going to do that a little bit and talk about, you know, one of the stories. One of them I wanted to talk about, you know, is really about competition, you know, and I was putting some of these slides together and it just dawned on me, or I guess it re-dawned on me, that we were supposed to have Summer Olympics this summer. The Tokyo Summer Olympics were supposed to happen, and they were actually supposed to end, you know, about 3 weeks ago. So we missed out on it this year. You know, I guess they're postponed until next year, which is a bummer, but I understand with all the other stuff going on. But just thinking about the Olympics, you know, I remember being glued to the television and watching them. And one thing always really fascinated me, it still fascinates me today, is how often we see world records broken at each Olympics. You know, especially in running events. You know, running is something human beings have been doing for a long, long time. Not something I do as a human being, but others have. And, you know, I would have thought that we really meet or matched our potential for how fast we could run. We shouldn't really see these records being broken, but we do. And one of the more interesting examples of this is actually the mile run. So according to Google, you know, I did a quick Google search to put this chart together. The first time the mile was recorded, or the fastest mile was recorded, was in 1855. That's up on the top left. It was, you know, set by a man named Charles Westall. You know, maybe he was the only man with a timepiece at that time, but anyways, he was able to record the first fastest time. And so his time was recorded at 4 minutes and 28 seconds. And so over the next 90 years, if we look on this chart, moving to the right, we see Westall's record being broken 25 times. And then we get to 1945, where a Swedish runner, Gunder Haag, broke it, and he set a new time of 4 minutes and 1.4 seconds. So from that point on, over the next decade, in race after race, runner after runner would approach Haag's record, but they were unable to match it or beat it. So, you know, beating Haag's record, you would have had to run this 4 minute mile. And running that 4 minute mile was kind of becoming this legendary feat. It was actually thought at the time that the 4 minute mile was impossible. You know, that was the point of human limitation. And if, someone did run a 4-minute mile, a lot of people believe that they would have likely died in the process. So for any of us who might be familiar with this story, we know that the record actually was broken. It was broken by this man, Sir Roger Bannister. He broke it in May of 1954. He ran the mile in 3 minutes and 59 seconds. So Bannister's, the most famous mile runner of all time, if you follow the mile run. But I wanted to spend a little bit of time talking about another runner, an Australian runner named John Landy, who many of us probably have never heard of. Before Bannister broke that 4-minute barrier, John Landy was actually the odds-on favorite to be the one to break it. And so if we look back at John Landy's career in those 18 months leading up to Bannister's historic run, what we find is that Landy recorded a mile race time of 4 minutes and 2 seconds 6 times, even running it 1 month before Roger, set the record. So, although Landy was the favorite to run the first 4-minute mile, from, his last few races, it was really beginning to seem like he'd kind of maxed out on his ability at 4 minutes and 2 seconds. It was seeming like Landy would never achieve it. And then all of a sudden, Bannister, who actually was an amateur at the time, he did the impossible. He broke the record. But what's interesting is that Bannister's record only held for 6 weeks. Because you might have guessed it, John Landy broke it just 1 or 6 weeks after Bannister did. He ran it with a time of 3 minutes and 58 seconds, just barely breaking it in June of 1954. So, the question I always have after this story is how is it that every runner in the world is trying to do the impossible for a decade with no success, and then all of a sudden we see 2 people run it within 6 weeks of one another? This really fascinates me. Landy would go on to run the sub 4-minute mile 5 other times in his career. And if we fast forward to present day, the present world record, it was set by a Moroccan runner named Hekam El Garouj. He ran it in 3 minutes and 43 seconds and 99. And in fact, if we do a Google search, Google will tell us that 1,400 runners have now run a sub 4-minute mile. So, I like this story for a few reasons. First, it's just a good story of the human spirit achieving, what was thought to be impossible. But the reason I share it for today's session is because it illustrates 2 things. First, it illustrates just how challenging it can be to improve performance. And second, it illustrates, how seeing one of our peers achieve results that we haven't before unlocks something in our psyche for us to follow suit. And simply put, this is really the goal of benchmarking, of peer-to-peer benchmarking. And so, the story is interesting, right? But the question we really should answer is, so what? How does it relate to the mortgage industry in 2020? Well, not a lot. Because in 2020, everyone can run a sub 4-minute mile, right? To keep the analogy going, it's almost like our mile run in 2020 was completely downhill. Maybe some of us weren't very prepared for it. Some of us forgot to even bring running clothes. Maybe there was some bleeding and vomiting. I don't know. 2020 really has just been a year like no other. And so the question is, what does benchmarking look like in 2020? Because obviously it looks a little different. Everyone looks like a top performer. And there's not really a profitability driven reason for us to want to improve performance. But there certainly is a capacity reason for us to streamline operations and improve performance there. And so to me, this is really the benchmarking opportunity in 2020. We should really pay attention to how we're trending compared to peers and whether our gaps are either growing or shrinking with those peers. And then, absolutely put an emphasis on identifying bottlenecks in operations. The one positive about all this production that we're having, it's very stressful, I know, but it's going to make those pain points hurt a little bit more in our operations folks. So we really just need to keep in tune with those and make sure we take a log of where those pain points are, because it's really a great year to identify those, even though, I know resources are really constrained.
So just to piggyback on some of Tyler's introduction, it really has been one of the best years we've seen ever. I get the pleasure of talking to my clients and hearing the stories about them meeting their yearly production goal through June, or having the best month in the history of mankind, of the entire, story of their company, which has been, I don't know, it's just been really great and exciting to hear. So this entire presentation is going to be nothing but positive statistics that we get to share with you all. Just to recount key events of 2020, in January, we were seeing some really strong home purchase numbers. I'd like to say that Tyler put this slide deck together. So this March 12th NCAA canceled March Madness. That's something that was really important to him. So I'm glad it needed it.
I didn't know how serious things were, with the COVID around the globe. And, we started to see stuff happen. We started to see it in the US, but once March Madness was canceled, I knew something was up.
Story.
So,
March, obviously the Olympics were canceled, the basketball was canceled. A lot of clients started going to remote workforces, but a couple other things that happened in the secondary market made March a really, really scary month. There was definitely some significant volatility. There was some big cash requirements for margin calls that, I can't count how many client conversations I had about, fears of, I don't have the cash to pay my margin calls. My net worth is a little weaker than I'd like it to be. And then also from the secondary providers, some conversations on, we don't know what's going to happen with pipelines or the market in general. And it seems like if you didn't have an agency ticket, you were even in more of a dire situation of, being concerned about who in the heck are you going to sell your loans to? But what surprised me is how quickly it flipped into a positive with the interest rates being so low, production being so high, and just some of our margin data that Tyler's going to go through later on. He is the guru when it comes to any mortgage banking metric out there, are astonishing. Like, we've been in this industry for a really long time, and some of the data and facts we're going to go over is, I don't know, it's been a good year. Obviously, not all good, but for our clients' profitability and production, it's been a really
highlight.
Good year. Yeah.
And so, when I look at the financial numbers, I'm trying to look at some of the events that are going on. And so when we look at those events, this is kind of what I'm seeing in the numbers, right? So Q2 of 2020, it's with the rates, we're having actually low rates, historic low rates. I know that phrase is used quite a bit in the industry. I'm not sure if it's lost all meaning today because we actually have new historic low rates. I'm not sure how they're going to quantify it when we move out of this environment.
Making.
Yeah, exactly. So we have actually historic low rates. The 30-year fix was below 3% in July. And so that obviously made an impact. The lockdowns, they disrupt business. They disrupted some hiring with some of our folks. And then, with hiring not being kind of a route that a lot of lenders could take to meet the production capacity that was in our pipeline, really lenders were only left with margins as a tool to manage capacity, and that was pretty much the only tool they had. I'm not really even sure if increasing margins did turn away much production. There was just so much of it, and these three things kind of coalesce into this, for lack of a better term, this perfect storm. Right? There are a lot of events that are unrelated to the industry, but they're kind of causing this perfect storm of I don't even know how to describe it, but it's just this perfect storm that really results in unprecedented numbers, to say the least here. So we are going to get into some charts and graphs here. We're not just going to talk about stuff we're not going to talk about just March Madness. But before we do, I just got to put a quick note, and this more than anything is just in here so that you guys can take it back for collateral and have an understanding of the data that we're presenting here. But for the first part of our presentation, the charts and graphs are really going to be driven off of one of our peer groups in our benchmarking program, which will be the global peer group. So that's RM Select Complete. And this group includes all the IMBs who participate in our program. It includes, multiple different channels. It includes lenders of all sizes. So it's really useful when we look at the trends over time. It's, as a standalone data point, when we're going to look at, secondary gain on sale, it might not be that meaningful. But at the end of the presentation, as long as we still have time, we'll look at some of these other peer groups too, to see, how the different peer groups are being affected in 2020 compared to historically how they've done. So we'll talk about those more when we get to it. But now on to some actual charts and graphs. So this chart, I think this chart could actually work for a number of different things in 2020. But no, it's not, a chart measuring anxiety levels. No, it's not a chart measuring how many calories we're taking now that we're all, or a lot of us are working from home and have, very small distances to our cupboards. But anyway, this is actually quarterly production volume. So it's an average for that RM Select Complete group. So it's quarterly production volume all the way back from 2012 when we started the program. I like to look at kind of the long history. I think it really speaks to what's going on. I know mortgage bankers tend to have a short memory, and that's very useful for a number of reasons, but I always like to take this long view to see kind of where we've been. And I really had to make the chart taller to fit Q2 in there, as you can see on the far right hand. Production just exploded over Q1. It's a 70% increase over Q1. And if we look at year-to-date production, so the first 6 months of 2020 compared to the first 6 months of 2019, production's almost double. So it's a 90% increase. So this is, not news to you guys. Just puts a little bit more context on what the whole industry is looking at, but production's been through the roof. Now this chart is going to be purchase volume only. So it's over that same period, but it's purchase volume. And this kind of goes back to, some of the numbers we were seeing in January, where we saw really strong purchase numbers. This shows that same trend has continued on, even with the lockdowns where, it's really hard for inspections and people to see houses, and there's not a lot of people putting their houses up for sale, but we're still seeing in the numbers that the purchase market is very strong. It continues to grow, especially with the IMB slice of the pie. And so this is really good. This is a good sign because most of the IMBs, their bread and butter is purchase business. And it just goes to show that, we can't forget about our realtor relationships during this time. We still got to maintain those and keep those a priority. One side note, Q1 is not all about, Q2 has been a great quarter in terms of production, but Q1 was also pretty high in terms of purchase production. It was actually the highest Q1 that we've seen of any of the past Q1s. Hopefully that makes sense. And if I need to, I can slow it down and explain that on another chart as well. So here's refi volume. So, refi volume, this chart, it's a little bit comical. In most of the charts that we're going to look at today, I kind of have to do a double take and say, man, is that really accurate? I even heard this from a lot of my clients where they were closing out months like June and they had double, triple, quadruple check their numbers because they thought, wait, these can't be right. This is monopoly numbers. But here's quarterly refi volume. During Q2, refi volume reaches 57%. So that's the highest refi share that we've seen in all the years, even 2012 when we had a significant refi boom. And then if we look at individually Q2, the refi volume is more than double that of any past refi volume. So just really significant. And then to put this number in a little bit more context, if you can see it on the chart, refi volume averaged about 700 million. And this is an average, again, per company. Again, it includes companies of all sizes. So that number, may not be significant to you guys individually. But that 700 million, if we were to look back to total volume and we assumed that there was zero purchase business in Q2, we still would have seen, total volume, if it was only the 700 million refi volume, come in at the second highest average for volume in the program's history for quarterly volume. So really, really significant volume. I don't know if I can state it enough. It's just been a very crazy quarter.
I'm sure they all feel it. I'm sure they're all feeling the hours and experiencing it.
Yep. And so, one of the other points that we mentioned is that when we're looking at pipelines that are massive and it's very difficult for us to meet capacity, as a management tool, we kind of, in general, we have two approaches we could take, right? We could try to hire more staff to meet the capacity, or, to keep the overextending of our workforce to a minimum or less of a maximum. The other option we have is we can increase margins, and most lenders are going to do both of these at different points during each year, depending on what the environment looks like. But for 2020, at a certain point, it was a little bit difficult to onboard. I know some clients had never onboarded someone remotely, and so hiring just was difficult. And given the amount of volume, even without lockdowns, I think it would have been nearly impossible to really put a damper in some of that capacity by hiring. So really, that was off the table as a tool to diminish the excess capacity. And so with that, when we're looking at number of closed loans per FTE, the math has to make it so that we're seeing quite a bit more output per employee or per headcount. So we do measure a number of closed loans per FTE, per full-time equivalent, as part of our benchmarking program. We do it at a number of different personnel levels, but this is going to be for all origination employees. So if we look on the left-hand side of this chart for Q1, we'll see about 1.75 closed loans per headcount. And this is going to be a monthly average, so that's per month. And then if we scroll over to the far right, we're just under 3 loans per FTE. We're actually at about 2.9, more specifically, closed loans per FTE. And so that's about a 30% increase over previous highs. And one of my other takeaways as I was putting this together is we can look at past highs, and usually 2012 was kind of one of those years that was, similar to 2020. It was kind of a year that was had some anomalies and made it hard to compare. But we really saw, much more significant production numbers. And then, obviously TRID came in 2015, and that really put a hamper in our operations and made it very difficult to come back to some of those 2012 figures. But really, if you look at Q3 of 2019, which is the peak just prior to the Q2 peak, those numbers are just about as high as we saw in 2012. So that's a really good sign for the industry overall that we've really overcome some of those challenges. And then, Q2 is just through the roof. So let's take a little bit or take a look at some of the other, department areas within the loans per FTE that we measure. A few that I thought would be interesting. We're not going to spend a ton of time on these. But I just thought it would be interesting to have some of these as collateral from the session. So this is processing. And from a benchmarking perspective, we measure processing at the department level. So we're going to include, management. We're going to include team leads, junior processors, senior processors. We also put closing disclosure specialists here and loan setup if you guys utilize those roles, and then processing assistants. So it's really a department level metric. And this is really just the reason we do that is just to get an apples to apples measurement to other companies. So just keep that in mind. And if we look through the chart, again, a lot of the same trends. We can look in 2012 and Q3 of 19. And it looks like 16 loans or so is about the high. Q2, we come in at 20.6 closed loans per FTE, or about 1 per workday, which is, really, really great numbers for processing. We'll take another look and we'll just look at underwriting. So underwriting, again, the same story for Q2 of 2012, or not 2012, excuse me, for Q2 of 2020, we're seeing averages at 45.7 closed loans per FTE, or just about 2 1/3 per day. And those numbers are really crazy. I know your underwriting teams are feeling it. And then we'll take one more look at closing, just so we can take a look at some of the other fulfillment departments. So closing probably actually saw even more significant jumps. It actually was about a 45% increase in output if we compare Q3 of 19 to Q2. And so we came in at 97 loans, or 4 3/4 loans per FTE. So, really crazy numbers that we're seeing in terms of output. Really amazing numbers that, like I said, are going to be irrelevant for benchmarks once the 2020 refi wave, comes to an end here, which I'm not going to try to predict when that'll happen. But so let's take a look now at the total cost to originate. And so total cost to originate, for this, it's going to be really most of your expenses. You know, the idea here is that we're getting all of your origination related expenses. So this is kind of your total origination cost per loan. So Q2 came in at $7,500 per loan, which actually is not really not that impressive. It's just slightly lower than Q3. You know, at some level, we might have thought that cost would come in a little bit lower, since there ends up being a pretty significant fixed cost component to cost to originate. And so we're not seeing that significant of a decrease. And so we'll answer that, why that is. It's mainly going to really come from a difference in what personnel costs did versus what operating costs did. And so we'll move there to the personnel chart. And so this kind of, you know, just shows what we were seeing earlier. So this is only personnel cost per loan. It's going to include, you know, LOs. It'll include sales support, processing, underwriting, closing, QC, secondary, and then your traditional corporate functions. And so if we compare Q2 of 2020 to any of the summer months, you know, in the last 3 years, again, it's really not significant. It's pretty close to what we see in a normal summer quarter. And then if we look back to a pre-trade quarter, it's not even really close to some of those costs. And so Jennifer, you know, she's going to share some of the insights of the conversations she's had for why costs haven't been lower.
It's on the slide too. Just conversations have been just a significant amount of overtime being paid to employees. You know, a lot of employees are meeting their productivity goals, their tiers in how they're paid on commissions. Also, I've heard some pretty large signing bonuses with, you know, people trying to recruit like underwriters, processors from other companies, like paid, you know, pretty high sign-on bonuses just to come in and do the work. I think the number one thing though is just the amount of time. I had one East Coast client tell me if they weren't working remote, he doesn't know how they would meet these production thresholds, because instead of people getting ready in the morning and sitting in rush hour traffic for an hour, they're working. So I thought that was, you know, kind of a positive spin on you know, being stuck at home.
Yeah, and it really just seems like we've kind of hit a ceiling or a floor. I don't know how you'd want to describe it with the cost though, because, you know, we've reached our point of, you know, no incremental improvement in terms of costs. Nobody's complaining about this. You know, I just wanted to mention it, as you guys might see it, just with how significant production is. And so, you know, really, again, 2020 is a year about managing staff burnout and trying to get through as much of our pipeline as we can. It's kind of funny, you know, to see bonuses for ops folks, because usually that's not what we're hearing a lot of, right? It's usually on the LO side of things, but it's just a very different year, you know, all around.
Yeah.
So now if we look at just the operating cost component of cost to originate, this is where we're really seeing more of the significant decreases. So for Q2, cost per loan came in at $964 per loan for just operating costs. That's a new record low. And then if we look at the individual line items, we see about a 15 to 30% decrease on all those line items. So, you know, rent, equipment, marketing, G&A, all those have about a 15 to 30% decrease from previous highs, which if we're just using Q3 of 2019 as a reference point, that would be where the decreases are coming or compared to. The one exception would be professional and technology related expense. Those were a little bit more on par. You know, I think with some of the cash now that people have on hand, some of those, you know, technology product or projects that people maybe didn't feel they had the budget for, didn't want to spend on, you know, that's not an issue anymore. You know, there still is an issue of resources in terms of getting implementations done, but that would be some of the things that we'd see driving some of those differences there. And so this is kind of the other point. You know, we talked about how lenders were really unable to address capacity through hiring. Their only option was really to increase pricing. So again, you know, this is something we do see quite common when production's high, that pricing goes up a little bit, just as lenders reach their capacity. And if we look at this chart, you know, we can see that on the far right, Q2 of 2020, we're really reaching previous highs that we've seen for secondary gain on sale. So it comes in just at under 370 basis points. And again, that number may not really make sense for your company because again, this is a blend of everyone. So retail, lenders are probably going to see a higher gain on sale. Wholesale is going to see a little bit lower. This is a mix. So, I wouldn't pay too much attention to those numbers in particular, but it's really just the trend. The trend quarter over quarter, 54 basis point increase over Q1. That's easily the most significant increase that we've seen. I think everybody is seeing this as a result. So, this kind of, again, this perfect storm of events that we're seeing going on where margins are way up, production is way up, productivity is way up just to get the loans closed. It's really producing very unusually high earnings. So earnings for Q2, they came in at 136 basis points. And again, this is our net production income number. So in that, it's origination platform profitability. So we'll pull out servicing income and expense. We also pull out the unfunded lock pipeline, which if we would have included it, that would have been an additional 64 basis points to this figure. So again, just the numbers are crazy. I look at these charts and I still almost have to question, did I double check these enough? Because they just don't seem right. But certainly that's what we're seeing across the board. Here's just a different look at net production income. So this is going to look at Q2 of 2020 compared to past Q2s. The business seems to be very seasonal. And so we can see what that looks like. Now, a lot of times when I'm doing a presentation like this, I'll talk about past years, some of the refi boom or refi wave years that we've seen. 2012 was one, 2015 and 16, and then 2019. And if we look at those years together, they come in at about an average of 77 basis points. Well, Q2 of 2020 is it's almost double that. And that's just crazy. It didn't seem like there was an extra 75 basis points or so to be earned, but that's just how crazy the numbers are.
So this one, the next two slides might be my favorite slides in the deck, just net production income in millions of dollars. So for Q2, 6 months of 2020, the NPI was 19.8. For the previous 2.5 years, then the net production income was 18.8 million. So within a 6-month time period, we've made more money than what?
Actually, no.
What?
That's only the Q2. That's a 3-month time period for Q2.
Gosh.
In 3 months in Q2,
it's an even better story.
We made more than the previous 30 months.
The previous 30 months. That's incredible. It's hard to wrap your head around those numbers.
Yeah, and those numbers might not mean anything to you. I usually don't do actual dollars because it's so specific to the size of your organization, but just to look at those, that just kind of sets me back.
And for this one, pre-tax net income in millions of dollars. So Q2, 3 months, 23.2 million. And then the previous 3 years, that pre-tax net income number was 20 million.
Yep. And so we're going to add back those servicing income and expense. We'll add back the pipeline gains, even more significant. And I don't really know what else to say. I think the chart really speaks for itself.
Yeah, we were going through the deck a little bit earlier, and we're having a conversation of, I've had more conversations from clients of, I have so much cash, I don't know what to do with it. And, we've been doing this for a long time, and that's not a conversation that is as common with a mortgage banking client.
Right, yeah.
It's nice to hear.
And so with, significant earnings, we're seeing that is affecting tangible net worth. So here's our adjusted tangible net worth. It's really equity minus goodwill or related party receivables. It's kind of our blanket calculation. And so this chart, again, in some ways, this is almost even crazier. We see net worth inch up, it goes down a little bit, inches up, inch up, down a little bit, and then all of a sudden it just shoots up. So it increased from 62% from Q1 to Q2. For now, stockholders are leaving most of earnings in equity. That's just for now. I don't expect that'll that'll just continue to be left there. Obviously there's a question of how much, should we have in there based on kind of our strategic outlook. And then, just to touch back on what Jennifer was saying, so 52% of that net worth is in cash. And that is quite a bit. I mean, usually that number is a little bit closer to 40%, but it's 40% of the net worth that we've been seeing. So going from 30 million all the way up to 57 million as an average is pretty significant. And some of the things that we've heard that clients are going to be doing is, one of the things we mentioned earlier was just kind of an interest, or 2020 being important to look to automate things. So, that's something that clients are going to be interested in, even if resources are tight. If they can be automating some of their processes, investing in technologies that are going to automate or streamline some of that, that's going to be something people are going to want to do for cash. I mean, if you're able to buy down your warehouse line, that might be something worthwhile. Basically any project that you think is going to, improve improve efficiency is something that a lot of our lenders are interested in. Some lenders are going to be interested in growing. It's a hard time to grow, and there's, other conversations about where the overall economy is and how that's going to play. We're not going to touch those because, one thing we've learned is we're not predictors of the future, especially in this industry. Okay, so, those were a lot of the trends that we're seeing. And those trends are really amazing. I wanted to spend a little bit of time, maybe switching gears a little bit and just talking about some of the different peer groups that we see in our benchmarking program. Here's some of the main ones that we put together. So we have the primary origination channels that we come up with. So we have retail, we have direct to consumer, and then we have a wholesale retail mix group. Retail, we're breaking down by large, medium, and small. And our large category is just anyone who's averaging over 3 billion annually. Our medium is going to be 1 to 3, and our small is under $1 billion. For 2020, those numbers are all going to be different. If you look at the average production, they wouldn't really match the group, but that's kind of how we break them up for this. And then we also have a top retail group. And this top retail group is really just supposed to be the most profitable lenders, the top 25%. We just define that based on top or net production income in basis points in dollars per loan. So it's not really influenced by size. And then contrary to, I think what popular belief would be is it's not really just the large lenders who make up that group. The large retail lenders do make up the largest portion of the group, but the second largest portion of that group would be made up of retail small, and then the smallest or the minority of that group would be retail medium. But this is kind of a nice look to see, okay, this is what the averages are doing. How are kind of the more profitable companies, what do they look like? Then again, we have direct to consumer, and by direct to consumer, all we really mean is it's still a retail origination channel. It's just heavily leveraged on marketing efforts, either purchasing leads, you're doing a lot of digital marketing on the internet or social media. Direct mail could be one of them. A lot of times they'll have a cost center or a call center receiving those. But it's very similar otherwise in terms of the margins for this lender. The one difference is that they're probably going to spend $700 to $800 more in marketing, and that's that if you just put that with their sales costs, you would kind of see their sales costs pretty comparable to the other retail channels. The wholesale retail mix, most of our clients who have significant wholesale channels do also have a retail channel. The split there, comes out to be an average of 60-40, but there's quite a bit of a mix there, and you can see that their performance, is a little bit different than the other group. Their margins are a little bit different. So one of the things I wanted to talk about is really the last 3 years and how these groups look differently. And so this is an average of the last 3 years. This would be 19, 18, and 17. And one of the things we'll take, maybe I'll just describe the chart a little bit so everybody understands what's going on. So the height of each bar is going to be your loan production revenues. So it's going to include secondary gain on sale. It'll include loan origination fees, net of your direct origination costs or the pass-through costs. And then it also includes your warehouse spread. So what we'll see, what you'll notice here is that the top retail group, their bar is the highest, so their total production revenue per loan is the highest. But that in itself is not necessarily what would distinguish them from other lenders. If we looked at all the individual lenders in that group, one thing that we would notice is actually most of those lenders have a higher contribution margin. And by contribution margin, what we're doing is we're just saying it's total production revenue less your sales costs. So whatever's left to cover, fulfillment, back office, and operating costs, that usually is the metric that those companies, show to be top performers. It's not necessarily just top line total production revenue. And it's really hard to see that in this chart, but basically if we took out that red bar, we would be left with contribution margin, whatever that looks like. And that would really be the gap there. There's about the last 3 years, there's been about a $700 to $900 gap in net production income per loan between them and the other groups, and that would be the biggest definer there. The other boxes, these are going to be the common expense items, at least the subtotal expense items. We do have more detail that we go into in our study, but so at the very bottom we got your total operating costs, a lot of your fixed costs. For back office, you got your corporate personnel, QC, secondary, post-closing. For fulfillment, we got processing, closing, and underwriting, and then your sales being your LOs, your LO assistants, account executives, and then if you have like branch receptionists, any type of branch support role that's not related to fulfillment would go into this piece here. And then the green is the net production income. So it's kind of your net production income margin per se. A couple other differences that you might notice that we'll talk about, the retail large group, they're going to have the highest sales cost per loan. And usually this is really driven just because they're more likely to have more layers of sales management in their org chart. So that's going to drive that piece of it. If you contrast that versus the retail small group, they're going to have more flat sales org hierarchies, and so that's going to be really the driver there. For the wholesale retail mix, some of their production comes from AEs, or a good portion of it, and so those numbers are almost not even comparable because their total production revenue is really net a lot of the purchase price that is paid to TPOs to get that production in the door. The two areas where we do find that most lenders are spending the most time benchmarking is going to be fulfillment and back office costs. But if we look at the retail large, the retail medium, the direct consumer, and the top retail, if we look at all these groups, the range between differences in fulfillment costs and back office costs is really tight. The range for fulfillment, it's only $61 from the lowest cost to the highest cost between those lenders. For back office, it's even tighter. It's only $33 per loan between those lenders. The reason I don't include the retail small in that group is really just because their cost difference is really a function of economies of scale. For these other groups, they've kind of reached a certain level where a lot of those economies of scales are something that they can take benefit in. And so it's not a surprise to me that those costs are such a tight range. Because usually most folks are really spending their time evaluating those and benchmarking those to make sure that those are as efficient as possible. And they are large line items. So it does make sense there. But, we want to leave some time for questions. I want to get through this chart too. I think we still have plenty of time. Yeah, and if you guys do have a question, please send them through the chat box. We want to be as interactive as we can through virtual meetings. But so this chart, basically, if we look at the left of it, this is that same chart we were just looking at. So it's the last 3 years of net production income. And then the chart to the right of it for each of these peer groups is what we see in 2020. And this would be year-to-date 2020. So this is all of 2020. And so I think the first thing we're going to notice is that the height of each bar for the 2020 period is quite a bit higher, right? And so this is just indicating how much we've seen total production revenues grow. And if we look at each of the individual peer groups, what we see clearly is that the retail large and the direct-to-consumer groups, they see by far the largest increase. then it would be followed by the top retail, the retail medium, and the retail small. I think actually, if you look at it, the retail large had the highest per loan, production revenue, a little higher than the top retail. It's a little bit difficult to see, but at any rate, we see them have the largest increase. And it's a little bit hard to put, precise data on why we're seeing this. But a couple of explanations would be, number one, if we remember at the end of Q3, at the end of March, when things were a little bit touch and go, and the aggregators really stopped purchasing servicing. If you didn't have your agency tickets, in particular, if you didn't have your Jenny ticket, and you didn't have the resources to retain some of that servicing, it made your margins it diminished your margins quite a bit, your secondary gain on sale. And so if we look at the retail large group, all of those lenders are going to have their ticket, their Jenny ticket, and they're all going to be at a place, from a resource standpoint where they may be more able, or thought at the time that they were more able to retain that servicing. The retail medium group, only about 60% of them have that Jenny ticket. And they actually tend to be a little bit more leaner. So they may be less likely to. And then that retail small group, a lot fewer of those lenders are going to have the Jenny ticket and not even have the option, to retain some of that servicing. And so that's a big part in the difference that we see. For the direct-to-consumer group, the only explanation that I can come up with, which is really, it's more anecdotal, and I think we see this a little bit with the retail large group, but the direct-to-consumer group, their bread and butter is refis. So their pipeline probably filled up, even quicker, even though everybody's filled up really quick, but it filled up a little bit quicker, and they're probably just a little bit more in tune with that they were able to identify, okay, now it's time for us to increase our margin. We don't need to, we certainly can do that, just given kind of their experience with the refis. And then I think the retail large group, and again, this is more anecdotal than it is anything, because we're going to see this with all the other companies, or at least a few companies in each of the group. They're just going to be a group that's more likely to use margins to manage capacity, primarily because, their problems just get multiplied. If they have a problem with capacity, they're going to feel it a little bit more just because of the extra production that they're doing, and they're probably a little bit more likely to really be on top of their data and having maybe quicker insight to, or visualizations to where they're at in the marketplace. If we look at the expense side of things, basically we could say, okay, what did expenses do? So we can really just look at the red, or the top of the red bars there, and that would tell us what total expenses did for each of these groups. And we can see that, for most of them, really all of them except for this wholesale retail mix group, they're all seeing about a similar decrease in costs, right? It's very similar. And most of that cost, again, is going to be attributable to the total operating costs at the very bottom. So if we look at that dark blue line, the difference in those two bars really translates to what we see at the top of the line. The other costs, there was some changes, but they're pretty insignificant given some of the other areas. So that was, really high level of some of the differences that we saw in this peer group, or in the different peer groups. I'm honestly not sure what to take away from it. I think one takeaway is hey, it's great to have your tickets. In particular, it really paid off to have your Jenny ticket this quarter. But is this going to be something that's going to come up again? I don't know. And I think most lenders, it's on the list to get their agency approvals if they haven't already. It's just a matter of time. It's just one of those things that for 2020, is a hard year to look at the benchmarks and to learn a lot from just those benchmarks alone, other than just kind of reinforcing the things that we see all the time in the industry, which is the industry changes quickly. It's helpful to be prepared and be able to kind of turn on a dime with where the industry is going, in all of that.
So Tyler, I have a question for you. Quarter Q3.
Yeah.
Is that going to blow everybody's mind as well?
I have not heard a lot from clients, other than, Q3 is still as busy as ever, that the pipelines are still as massive as ever. I think Q3 is actually going to be better. I think we're going to see the earnings numbers are going to be better. I think that's the only way for it to go. We're not going to see a disparity in margins because we don't have that volatility in the secondary market. So everyone's margins are going to be up. It's going to be, even crazier probably.
What statistics are you seeing on like servicing and retention with servicing?
So we are seeing a lot more lenders retain servicing. Some of them have decided that they're just going to retain almost everything. And those lenders, again, are going to be some of the larger lenders. I did not see a ton of new servicers. I know that there was some, but everybody did seem to, who had been retaining did seem to up it a little bit. I did notice that with servicing, a lot of the lenders who were retaining it felt a little bit uncomfortable with how to value that, which I understand because, it's hard to say what that's going to look like or, what prepayment's going to look like until we get further on down the road. But if you are retaining servicing, one of the things, and this is kind of a benchmarking pet peeve, is we want to make sure we set up the proper chart of accounts to get that going. So, certainly give us a call if you have any questions on that. We want to make sure that those are there because that's pretty crucial in order to be able to kind of benchmark your own secondary gain on sale versus your servicing operations. You got to have the right account set up there. But in terms of overall portfolio values, I didn't put something in here because it didn't seem significant yet, but the fair values of portfolios came in at about 75 basis points, which is a little bit lower than usual. I think it's, it was only 6 or 10 basis points lower than what we saw for Q1. So a lot of, there's still a lot of speculation. I know some people, if we're going to come out of this and there's not going to be a major economic impact overall, this would be a great time to retain servicing because in theory, those loans are going to stay on the books for quite a while, right? But, there's still a lot up in the air.
Yeah. Yeah, I haven't heard, a lot of the conversations I've had with clients has been forbearances haven't been that bad compared to, there's what the market says and that's what our client base says. And I feel like our clients haven't been hit as hard.
No, we're definitely not seeing it in the portfolio values yet. Of course, I get my MBA emails, so every day I get an update on what the forbearance is doing. So, yeah.
Good.
Was there any other questions? Now would be a great time to send those in. I think we mentioned it earlier. We will get a slide deck to everyone, so I hope you weren't frantically writing down any of those here. We'll make sure you get those and have them. After the fact, we're happy to have conversations if there's more questions about, what do these numbers mean? I love benchmarking, so I spend my days thinking about it. So happy to have those conversations.
Tyler, I'm going to just interject real quick. We are going to send the slides out with the recording, so everyone will have both the wonderful narrative that Tyler and Jen have given us today on these slides, as well as the slides as themselves. We did have a couple questions, and it looks like you covered one already, but Cheryl wanted to know, back when we were talking about the full-time employee work slides, did you calculate those based on a 40-hour work week, or is it per employee? So if a full-time employee works 80 hours in 1 week, do you count them as 2?
That's a great question. So our FTE is actually, it's more simple than that. So we do it based on a start date and a term date. So it's really reflective of kind of your head count that you have. So our numbers, our efficiency numbers are obviously going to be inflated that way, right? Because, even though people are working more than 40 hours, we're not recording them as like a 1.25 or a 1.5 FTE for that calculation. It's just a more simple calculation.
Thank you for clearing that up. And then Paulina also wanted to know on the slide referring to the average Q2 earnings, the one where you compared the past few years to just Q2, is the derivative pulled from the net income? Oh, you passed it up. Oh, yep, nope, sorry, that's right. You're correct there. Was the derivative pulled from net income?
Yeah, so for net production income, we always pull the unrealized gain or loss tied to that derivative. And the reason is not because it's not part of our origination platform. The reason is simply because we're just things in terms of closed loans and closed units. So, you know, that tends to skew the numbers. In fact, you know, if we did that, I think there'd probably be like 125 basis point gain. And that's just mainly you know, just the way we calculate the numbers. I know that the MBA probably includes that number in their gain on sale. But yeah, we do pull that out just to make it a little bit more realistic to what we think people are seeing in their secondary gain on sale over the past quarter.
Right, and it looks like we have one more question here. Angie would like to know, she said she's not sure if she missed this. Did you say that the MSR values went down 6 to 10 basis points over Q1? And how does that look compared to Q4 of 2019?
Oh, that's a good question. You know, I don't know off the top of my head what they were compared to Q4, but I will be happy to send that information to you, Jordan, so you can distribute it with the slides. Yeah, and the servicing values did go down about 6 to 10 basis points. I'll give you a more precise number on that as well, so you guys can all have that.
Okay, well, Jen and Tyler, was there anything else you guys wanted to go over before we wrap up the call?
No, I don't think so. I mean, I think, you know, we just look at it and it is a highlight of 2020 in a year where there's a lot of other stuff going on. You know, it certainly is, it has kept things interesting. And, you know, I think one of my major takeaways is that, you know, I'm never surprised by what happens in this industry. And I'm always surprised at what happens in this industry. So, yeah. What about you, Jennifer? Anything?
No, it's been a good year. There were some moments of pure panic, I think, from a lot of people in the industry, and thank goodness it was kind of short-lived. And I think people are just enjoying, and you know, just trying to keep their head above water with everything going on. I think a lot of like just trying to get through the day.
Yeah.
Get everything off your list.
And unfortunately, and fortunately, I mean, I think that this is kind of what the market's going to be like for the next few quarters. And it's hard to predict, but well, people are going to have to figure out how to get some life work balance, even with all these pipelines. But, you know, a lot of good problems for mortgage companies for sure.
Well, thank you guys so much for sharing all of this great knowledge with us. And I can't thank you enough for joining us today. And thank you everyone for tuning in. Special shout out to all of our sponsors. You'll get to see a nice little slide. Oh, there they are.
I had them, but I missed them.
Yeah, so close. But we have some great sponsors for this Industry Insights series. We will be continuing it on next Wednesday with Jim Deitch. He's going to talk about the emerging role of financial executives in business strategy. If you guys have any more questions, please feel free to reach out to me and I will be able to connect you with Jen and Tyler. Have a wonderful day, guys. Thanks for joining us.
Thanks, everyone.
Thank you.